Welcome back. In this week's video, we're going to be talking about the location concept, how we can identify range phases and trend phases in the market, and how we can understand our trade locations. Trade locations is going to give us the ability to stop taking low probable trades and start taking higher probable positions in the market. We know that over time, if we're able to put ourselves in higher probable positions, we're able to catch some of the biggest moves in the markets. This is exactly what I talk about in my 1 minute trade PDF. Have a look in the description for the link below. You can get access to this full PDF. I go over my exact processes I use to trade my 1 minute process during London session. This is one of the major concepts that we're able to sustain over 20 profitable traders within our community that we mentor each week. One thing that we see consistent across all of our profitable traders is their trade locations. Not only do they trade in good locations that give them higher probable results, but they do it knowingly, knowing the location of their trade, confidently taking that trade execution, knowing the probability of the trade. As professional traders, we need to know the location of our session. If we can know the location of our session, we can start to understand if we are in a higher probable position or a low probable position in the markets. This is going to allow us to avoid taking simple losses that we're trading in the wrong direction and take those higher probable decisions where we see market moving in one direction. And in order to achieve this, we need to have a repeatable process, and that's where location comes in. So there's two things we need to understand to know when we're trading in a higher probable location or a low probable location. As professional traders, we need to know this information because when we take trades over time, we need to know, are we trading with the probability of the market or are we trading against the probability of the markets? And to know the probability is to know the location. And that's exactly what we're going to talk about in a ranging market. So how do we know the location in a ranging market? Well, what we want to do is take a to B in the market where we can see prices contained. So here we can see a low point and a high point presented to us in the markets. And this can become our A to B that has been presented to us. And as we see, market is pulling back into the range and we see price here tap back into 50%. So this is how we know we've created A to B in the markets. And what we want to see next is price contained. If price is not contained, then this bearish movement here, it will continue below the previous low and we will not be looking at a ranging market. But what we can see here is price comes down to the previous low and then price remains contained as we see price moving back into the high of the range. And over time, we can see that price moves above a previous high and then moves in the opposite direction back into the range. And over time, we see that we've been delivered a sideways market. Now, in hindsight, if we was trading this delivery, now this could be a 5 minute chart, a 1 minute chart, a higher time frame chart. What we're trying to understand is, where have I placed my trades? Have I traded in a higher probable location or a low probable location? And the way we can understand this information is seeing that the edges of a range are seen as higher probability. And if the edges of the range are high probability, then we know that the middle of the range is going to equal low probability. And what we're saying here is, if I'm taking trades around the middle of the range, then this is equal to low probable trading. And if I'm taking trades at the edge of the range, then this is considered high probable trading. So what we want to see here is when price gets into this low prices, we want to see price create a bullish delivery. And when price is presented at the high of the range, we want to see that bearish delivery presented in the markets. When price is in a range, when price is contained, this is the likely situation that we're going to see. We're going to see price bouncing from high to low, price being contained. And this is what we understand as higher probable trading inside of a range. So when we think about the locations of our trades, let's say we're looking at this in hindsight, we've played this delivery over time. Let's say this is a week of delivery and our sessions have presented certain locations in the market. Where have we placed our trades? Well, we would hope that most of our trades are going to be located for bearish prices at the higher edge of the market. So in higher prices, again, we don't know the location. We're looking at this in hindsight. We would hope that we're selling in and around this location. We would hope that we're buying in and around these locations in these low prices. And also, we would hope that we avoid this type of area in the markets where we see price moving in the middle, and we would hope that our positions are located outside of this area. The reason for that is because it's in this middle location, what we can see is price moving in both directions. So we can see price run this low, then it might run a lower time frame high, then a low, then it might move down, then it might move up again, it might move down, come to the edge, and it moves back into the middle, then it takes the high, then it takes the low, then it takes the high and moves back to the high of the edge. And we see that there's a lot of manipulation happening around that 50% location, and we know the reason for this. If you don't know, make sure you check out our Trading Missing Pieces course where we go over who controls the market. From the understanding, we know this to be a low probable location. So in hindsight, we don't want to see our trades in and around this location. So of course, we want to understand how can we present ourselves in high probable locations over our series of trades, where we can look back in hindsight and say, yes, most of our trades was in the correct locations, where we was buying from high probable locations and we were selling from high probable locations. This is going to be the way that we can yield the biggest results in the markets, being in the correct direction. So this is the range, and this is how we understand the high probable locations and the low probable locations in our session. The next observation we need to understand is a trending market. We've gone over what a range market is and how we can identify the high probable locations in a range of market. Remember, this information is fractal, so we can use this over any time frame. Second, we can go over the trending market. So here we can see the market moving up, creating higher highs and higher lows. We can see this mainly from price moving above its previous highs, price moving above its previous highs, price moving above its previous highs, and here once again, price moving above previous highs here. Clearly, market is moving in one direction, and that bullish structure is creating A to Bs in the market. So we can see here, we have an A to B created and price pulling back into 50%. We have another A to B created, price again pulling back into 50%. We have another A to B created. We can see here that price is pulling back into the edge of this A to B. Once again, we have a A to B create and prices again pulling back into the edge of this A to B, and we're seeing this continuation market. Now, in a market that's moving up or down in one direction, this is very typical delivery that we're going to see. And once again, in hindsight, what we would want to know is that we are buying in and around these locations for higher prices. When we think about the opportunity created in this type of delivery where price is initiating higher, we want to be in those pullbacks, in those continuation directions. So here we can clearly see that price pulling back in a bearish direction is going to give us the ability to catch the continuation in a bullish direction. And over time, we can understand that those high probable locations come off the back of those pullbacks. And when price is pulling back, we need to understand that we need an area that is consistent, we can identify to be high probability. And that would be that 50% location. So when we see price moving higher and price pulling back into 50% of a previous A to B, it's in this location that we want to see price start to reverse and continue in that bullish direction. When we see that, we know that the intention is continuing, and what we want to see is that intention for higher prices. You want to see those large candles to the upside, a clear continuation in that direction. So when we think of high probability locations in the trending market, we have to think about the 50% location. We know that the edge of a range is also higher probable. This is why we also look at the edge of the range as being a higher probable location. So think about it, we have that 50% and we have at the edge of the range. So to know the location in our session, when we're in this clear structure that is showing initiation to the upside, that 50% location is going to be that higher probable area that we want to see price move in. That move would be to the upside. And once again, when price is pulling back into 50%, we can see here price isn't pulling back as deep, but it still is coming from that 50% area. So again, we know that this will be an observation location. So this one now, we can see that price is ranging, moving higher, and then moving back into a previous range mitigation. Although we would be looking at 50%, we know that eventually in these trending markets, price does pull back to its previous lows. We know this to become future liquidity that price can start to aim for. We know that this becomes cause for the opposite intention when price starts to reverse. But when price is moving in one direction, we can look at those 50% and edge locations as those higher probable areas. So then what would be low probable? Well, low probable would be the opposite side of the range. So if price is bullish and then we're buying in this location, then this would be considered low probability. Because in a bullish trending market, to buy high is the opposite of high probability. What we want to be doing is buying low in the market. And the representation of a previous low to previous high is a representation of an A to B. And when price is pulling back into that swing structure, we know that this location will become cause for higher prices. So this would be considered high probability. And when price comes into those higher prices, this will actually be considered a sell location. So if we're looking for buys here, that would actually be considered low probability. And if we're also looking for sells here, it would also be considered as low probability because we're trading against the trend that is being shown to us, against the intention. So we know this to be a low probable decision. So a lot of the times what we see here from traders is we're not participating in this area of the market. And what we focus on is participating at the low of a previous A to B in the markets. So now we understand the probabilities of a ranger market and a trender market. We can now start to look at live market examples using this repeatable process. Now we're on a higher time frame on the hourly chart, and we're looking at this past few weeks of delivery. And what we want to understand is the location of our session. We're going to be focusing on London session and New York session, wanting to know the location that we're presented in. We will be going down to the lower timeframes. Remember, we're looking at this information so we can take higher probability positions on the lower time frame chart, which is the 1 minute, and we can look for our 1 minute trade entry. That's going to be that precision execution on the 1 minute chart, trading in the correct direction. And to trade in that correct direction, we need to know the location of our session so we can put ourselves in the high probability direction over and over again. This is really simple. All we need to do is just repeatedly execute the same processes. We're going to be looking at here is this previous low where we can see an obvious rejection of lower prices, and we see price move higher into a previous range. That range creates a mitigation where we see a reaction in price and we see a continuation to the upside. Now, what's really key about this structure, remember, we have to understand the structure to know the location of the markets. So what we can see from this structure is that we've started from a sideways range here and price is then initiated in that bullish direction. So if we're able to understand ranges in the market, then we can start to look at those initiation phases that are presented to us. So here we can see a clear initiation phase where price is moving higher and then price is pulling back. And what we can do here is see that price does not pull back to 50%. So we know this to be a continuation style market. Typically, this is showing in an initiation market, and we do identify initiation structure here. So this is exactly what we'll be predicting in this moment, and we can see a run of a previous low in our session into higher prices. We'll be focusing on this price delivery that we're observing now coming into our London session right here. And we can see that based on market structure, we are bullish in a bullish trend. And what I'm looking for is A to Bs that are presented in the market. So clearly, when price is presented in my session, what I start to see presented to me is a new A to B in the market. So we can see price stretching and price closes. So clear, we can see the intention coming from that midpoint. Think about it. When price is in a trend, where do we want to be interested in? We want to be interested in that 50% location. What we want to be doing based on that delivery, let's say we're looking at this in hindsight, we would know that we would want our trades placed in and around that 50% location. And what we wouldn't want to do is place sells against that intention because that will be equal to low probable positions in the markets. And also to buy here would be also equal to low probable. We can see that the buy overall does work out. And although we understand that buy to be low probable positions, we do know that it's coming from a initiation market. So we can actually look at taking positions here on a lower time frame, but that's a bit more advanced. When the trader understands locations, these are the types of decisions we can make in the moment. We're not afraid to what might happen next. Actually, what we start to do is position ourselves based on the structure that we're observing. So here we see market continue. And like I said, market in our session is then continuing into higher prices. So that's what we're seeing in hindsight. But before we get into our session, what type of structure are we seeing based on a previous A to B created in the markets, as we can see here, and price moving sideways inside of this A to B, we can see that we're approaching this high location. And we would not be looking to buy here because we will be buying high. We know that to be low probability. We would not be looking to sell here because we're selling against the intention of the market. So actually we see that the session location has been presented to us as a low probable position. So then when we get down to the lower time frames, as much as we might want to be involved in this market that is moving in one direction, moving into our session, we do know that buying here would be on the lower end of probability, causing us to sit on our hands for the session and not look at any trades. As we get into lower time frames, we'll start to observe this delivery. The first day of the week there. On our second day, we do see price continue in that bullish direction. So now we can map our new A to B in the markets, where we can see previous low to previous high, and market then in London session, we can see that this is the location of the move. So based on the previous A to B in the markets, we're now able to understand the session location. So what do we know? We know that to buy here would be low probable because we're buying at the top of A to B, which would be low probable because we don't expect the market to continue from high prices. We want to think about buying low. So in the A to B market, where would we be looking? We'll be looking around that 50% location. So knowing that this is potential B coming into our session, we can start to play back in to the range that is being presented to us, knowing that if we was to sell here, then we will be selling in a high probable location, because we do know that taking sells at the high of an A to B is on the side of higher probability. Now you might think, okay, why here? Why are we looking for sells at this point in the markets? And that's clearly because price is taken out a prior high and we see a lack of extension. So price isn't extending to the upside. So we do actually expect price to pull back. And this is quite natural for price to pull back after creating a new A to B in the markets. So now if we was to continue our observations of that new low, new high, and we was to then present ourselves over time, we can see that the session is presenting to us for the next day in a low location. So if this is our previous A to B and our price is pulling back into our previous A to B, this is now priced in discounted prices. So quite easy then for this session here, we'll be looking for bullish delivery in price. We'll be looking for price to move higher from discounted prices. We know that this would be considered higher probability when thinking about buying. So when price is in this discounted location, this is more on the side of that higher probable trading. This is the locations that in hindsight, we hope to present ourselves in. We hope we're buying around these locations, because what do we see after? We see the continuation of the trend. That's what's most important, because the direction of the market was already shown to us. So the fact that we can present ourselves on the correct side of the markets shows us that we're knowing the higher probable nature and we're following it. So we know that to be higher probability. And what can we see for our next session? The next session is presenting us in a location where price is now high in the range. So this is where London session has presented us. So for this day, we was low. Notice that price went to the other side of the range. If you notice that in New York, we was high. So I would be looking for sells back into the middle of the range, anticipating sideways delivery based on this A to B creation. I would be selling from higher prices. I would see this as higher probability trading for a New York session. We can see that the next session is presented again in these higher probability location for low prices. So I would be looking for sells. We do see here price continue to the upside. And why is that? It's because when we identify market structure, we can see that price is creating initiation delivery to the upside, and we can see that price on those lower time frame A to Bs is moving into that 50% location and moving higher in price. So actually, if we was to look at the intention that was shown in the markets and seeing that structure that was presented to us, actually at this time in the session, as much as we could have been selling the markets, this would also be looked at as low probability because we're trading against the intention here. So really think about it. When we're making those repeatable decisions, we need to understand that yes, we can be in low probability, yes, we can be in higher probability, but we want to be following the intentions of the markets, and range initiation, mitigation, continuation is going to put us on the correct side of that intention. An avoidable trade here in the wrong direction. We see price over time is high, and then we're spiking high here and price is pulling back. This session in New York, we saw price move into new higher prices. So now we have a new A to B in the markets. So let's mark that up. We have our low point to our high point. And what do we see over time for our next session? That price is moving back into the middle of the range now. And we can see that over time, prices just move sideways. If I just pull this back here, we can see that price has really just presented itself sideways, because by the time we get into our next session here for London, we're presented once again back in to the middle of the range. So this would again be considered low probable trading because we're trading at 50%. But what can we see? We can see that range in the markets where we see market moving sideways, and then we start to see that direction shown in the markets here to the downside, price pulling back, and then price continuing to the other side of the range. Remember, very, very important here, price is moving to the other side of the range. And we can see as price has gone on, we've remained contained. So if we're looking at this delivery and we're asking ourselves, okay, what should I be doing over this time? Well, as we saw in the previous diagram, this would be the location to look for higher probability buys. This would be the location to look for high probability sells. And we can see that over those next sessions, the only high probable opportunities we are presented are the buy conditions. And actually, if we are trading in the middle of the range, what do we see? We see that there's a lot of buying and selling in the middle of the range. And what do we know from the middle of the range? We know this location to be low probability. We can understand that knowing the location going into our session can allow us to make repeatable decisions. And what we then do is, rather than look at the market blank and saying, should I be buying, should I be selling? Actually, what we're doing is using a repeatable concept to put ourselves in a higher probable location when we're making our good decisions. And when we're not in a high probable location, we know that those decisions are going to be made are going to be low probable. So then that can avoid us making those decisions, giving us reasons not to take pointless losses and avoid low probable trading. Now let's zoom into the structure. We know now, we've just kind of quickly gone over the locations of the session. Really, the days I want to focus on are the higher probable days. We know session to be higher probable. So when we look at London session on this day, we can think about following the intention that has been shown to us, that previous bearish intention. When we look at London session on this day, we can think about trading the mitigation in discounted prices. So you can look at this day here. So really think about this. When we go to lower time frames, let's understand where are we located and how are we making these decisions during our session. Down on lower time frame, we're looking at this highlighted section we looked at on the higher time frames, and we can see that coming into London session, we can start to look at the structure we presented. This is from 7 a.m. to 10 a.m. I trade from 8 o'clock. So from this point onwards, so this is going to be the focus when we want to identify those higher probability positions in the markets. Remember that we're using fractal information here. So what we should be doing is following the higher probability direction that has been shown in the markets. Coming into our session, what can we see? We can see the structure of the market has created a low, created a high, created a higher high, and pulled back into that midpoint. So now we're starting to establish that price is sideways from that new A to B. Someone might look at this as being bullish. For me, over time, I can see that this is sideways. What I'm actually anticipating now is that price is going to leave the range in a direction. This is London session. We know that London session does create direction in the market. I'm looking for price to extend about 20 to 30 pips in my session. That's going to allow me to TP those 1 to 5s, 1 to 10s. So moving into the session, we can see that that structure that is shown to us, again, in that ranging structure, we're presented a high location here. So I know this to be a higher probable location to look for sells. I also know this to be a sideways range. So if I'm going to be doing any deals here, I'm going to be selling high, I'm going to be buying low, and I'm going to be avoiding that 50% of the market. And we can see here prices moving above previous highs. We do get that range initiation into low prices. And that is the first observation of intention shown from a previous range shown in the markets. And remember, this is a location that we would have been looking for sells. For me, there's no sell setups here, but we would have been looking for sells in this location, understanding that if we start to see direction shown from this higher probable location on the higher time frame and this higher probable location on the lower time frame, then we can start to look for those continuation trades. Remember that in a to B market, in a new A to B market, we want to start looking for those trades in and around 50%. And that's exactly what we can identify here. We have this high. Notice that we have a new low presented to us here. I'm just going to get rid of that previous range. We see our price doesn't pull back to 50%, so we still know that we're extending. Price is coming down, we're pulling back. We're still not really extending, pulling back to that 50%. Still price is moving lower, and then we see prices eventually coming back up into that 50% location. We can see that there is a previous lower time frame range there where price is mitigating and continuing in the bearish direction. This can become the identification of higher probability. Remember that it's the 50% location that we want to identify for those continuation trades when price is showing intention in one direction. So clearly we've been able to see the intention in the markets. That intention has been for lower prices. And what we've done then is based on that A to B that has been presented in the markets, A to B, that bearish A to B, notice that it's a new A to B, run the high. We also run the low, create the new low, and then prices pulling back into 50%. And then as we continue, notice that as soon as we break the low, price starts to pull back. We can understand this to be still contained price. So for me, I would be looking at moving my A to B down. And we can still see that price is still mitigating outside of the session, but still mitigating that 50% location to show that direction for that session. Now, looking at how we can be a part of this trade, think about it. We've seen the intention from a high probable location moving one direction. That has created our A to B in the markets. Price is then pulled back into 50% of the range, where we see a noticeable high that created the low. This is a range that we can look at for a mitigation. Price moves into the point of mitigation. This is exactly where we can take our executions from inside the mitigation, and we want our stops to be relatively above previous highs in the market. So we can look at having above that previous high. We can see a very small stop loss here, and we can see price moving in that 5R direction. Price over time still mitigating the same location and showing that directional move. What are we seeing here? We're seeing the trend continue. What are we seeing as well? We're seeing prices not pulling back to the edge. So since price is not pulling back to the edge, we know this to be a trend in market. And when we think about a trend in market, we want to think about those good locations to take trades in. Here we can see another new A to B created in the markets. We can see price pulling back up into that 50% location. Here we can see a range in and around this location. We notice that this price does create the breaking structure, and then price is pulling back to mitigate. Once again, we'll be looking at taking a trade inside of the range with our stop above the previous high. Once again, looking for that big RR in the markets, allowing us to capture those moves consistently in the correct direction. So clear session for trending delivery. Notice that we're trading from a higher probable location on the higher time frames, and this is giving me confidence to trade in the bearish direction. And when we start to understand that initiation structure in the markets, we can start to follow it and position ourselves quite accurately at the points of mitigations. A very nice session indeed. Okay, so for the next day, where do we know we're located? We know that session is opened up in discounted prices. we can see we've just taken that previous low, and to our left here, we do have a previous sideways range in the markets. We'll see it across multiple time frames, and this does become a point of mitigation. So think about the structure we've seen. We're seeing price at a previous low in the markets in discounted prices. So then on a 1 minute time frame, we can sit here and observe what comes next. As you know, I'm looking for trades after 8 o'clock. So we just put this on here after 8, and we can quickly identify the structure in the markets. So quite quickly, we can see that over time, we do have price ranging here, price moving sideways and moving outside of the range. See price continuing that ranging structure here, moving to the upside. Once again, we get a lower time frame range, price clearly range initiation to the upside. So this is how we're presented in my session. If you notice here that if I'm looking at this on a lower time frame perspective, that this could be considered a sell location based on the previous A to B in the markets and price pulling back into the previous high like this. And we may be starting to look for sell decisions here based on the previous high range in the markets. But what do we know from a higher time frame perspective? That this is a low probable location to look for sells in the market, because this will be considered selling low. What we want to do is sell high in the market. Selling high is equal to high probability, and selling low is equal to low probability. So we don't have to look for sells in our session. What we can actually do is look for buys based on the location and the information we've been presented with. So let's continue to observe the structure that we've been presented. We can see that initiation delivery is starting to present to us. We see range, initiation to the upside, clear range initiation. And once again, we see that range presented to us. And then we see initiation to the upside. Clearly, new A to B being presented, because as price is moving higher here, we see that price creates that new A to B. Think about just coming into our session, we're just seeing price move higher. That's the first thing we've seen is just price range initiate to the upside. So this is creating a new A to B in the markets. We see we run above the previous high, and then more price starts to pull back into our previous range. And what do we notice? We notice that price pulls back into a previous range in this 50% location. So this could become an observation. We also see that we do have a previous low here that we can base our stops on. And this becomes an execution opportunity where once again, we can think about buying at 50%, looking to buy high based on that narrative. And once again, we can manage our execution inside of the range, looking for those high R moves in that bullish direction. So why are we buying here? It's because we can see the clear range initiation has been presented in our session. And when we think about being a part of that delivery, we can think about being a part of that pullback continuation for higher prices. Now, there are some other nuances in here that we can identify that makes this even higher probability execution. And this is exactly how we want to be trading in our sessions. So there's two variations of trades there, both following a trending market, both following good locations that have been presented to you in your session. When it comes to making these repeatable decisions, what we have to do is use our concepts in a repeatable way. So have a look at that 1 minute trade entry PDF where I covered this in much greater detail. Thanks for watching, guys. Let me know in the comments if you enjoyed this one, and I'll catch you on the next video.